Wellbeing webinar for January 2026. Today's topic, we are going to be discussing what questions to ask when buying a house and also getting mortgage ready. So in a second, there's a few more people joining the webinar. In a second, I'll share my screen and you'll see the slides in front of me, and you can follow the content as we go along. On every slide, you will see our contact details on every page, which will show up any second here. So you'll see an email address and a telephone number for us. So our name is First Mortgage. We're the mortgage broker. We've got a partnership with London Ambulance Service, as well as a host of other NHS trusts, including Manchester Foundation Trust, University Hospitals Birmingham, and North West Ambulance Service, to name a few of the larger trusts we work with, alongside London Ambulance Service, of course, as well. Our details are on every page. So we've got a telephone number here, 01225 970 830. And email address is hellobath@firstmortgage.co.uk. So at any point, feel free to take the details down. At the end of the webinar, or now, you can obviously get in touch with the team, book in a free consultation to discuss individually your mortgage needs in terms of how much you can borrow, what rate you're eligible for, how much deposit you need, all that kind of information, or ask any basic questions. Equally, there will be a Q&A at the end of this webinar. I'm expecting this webinar to be about 25 minutes long, roughly, and there'll be a Q&A at the end, so you can stop me and ask any questions in the chat as well. So as I said, this will be recorded, just to make you aware, so keep your microphones off and keep your face off the camera off as well, if you don't want to be recorded on the screen. And we'll get started with the topic. So January 2026, it's the latest in the monthly series of financial wellbeing webinars between First Mortgage and London Ambulance Service. As I mentioned already, the topic today is on what questions to ask when buying a house and also getting mortgage ready. So in terms of the agenda, for those of you who haven't attended any of these webinars before, we'll give you a quick overview of who First Mortgage are, what we do, what our service entails. We'll then run through and look at how to get mortgage ready and the best ways to prepare for a new mortgage application, especially prevalent for those first-time buyers amongst the group and those obviously viewing this webinar a bit later on. So we'll look at how important your credit score is and ways to improve your credit score. We'll then look at the supporting documents you need to gather in terms of proof of ID, proof of income, proof of deposit, all that kind of information. Make sure you've got that ready before you apply for a mortgage. We'll look at generic questions to ask about the property itself, which will put you in the best stead when you try to negotiate on the price, and also questions basically to protect you in the house buying process. We'll then move on to looking at how you get financially qualified before you actually make an offer. So the steps involved in the house buying process, what you need to do as a buyer to ensure you're ready to make an offer and you're ready to obviously get the finance in place on the new property. Which also involves getting a decision in principle certificate, or a lot of people call that an agreement in principle certificate, AIP or DIP for short. It's the same thing, just different terminology. Agreement in principle or decision in principle essentially is a certificate which confirms how much you can borrow based on your circumstances after you've spoken to a mortgage broker. We'll then look at the next steps in the house buying process in terms of the role with the solicitors and how you move forward to completion before you get the keys and move into the property. And at the end of the webinar, there'll be a quick market overview, give you a quick idea of mortgage rates, the Bank being the base rate, and where we're heading for the remainder of 2026. And as I mentioned at the start, there will be a Q&A, an opportunity to book in a free one-to-one consultation. So just to summarise again, we have got our contact details on every single page here. We've got our website, firstmortgage.co.uk. Best thing to do if you want a free appointment to speak to one of our mortgage experts, we do those over the phone or on a Teams or Zoom call, generally speaking. And you can email the team, hellobath@firstmortgage.co.uk. We're based in Bath, that's why we've got the Bath in our email address there, and telephone number 01225 970 830. There's just a few more people coming into the chat as well. Okay, so let's go through the first part. So who are First Mortgage? So for those of you who haven't attended any of these educational webinars before, so First Mortgage, we're an award-winning firm of mortgage advisors, and we specialise in the financial wellbeing space. So we work alongside a number of NHS trusts already. We deliver basically educational webinars on a range of topics, mainly to do with mortgages, but other sort of forms of financial wellbeing, including financial protection, on a monthly basis. So in terms of how we operate, we're completely fees free. We don't charge a fee at all for any of the advice we give, either now or in the future. And we don't charge a fee at all for holding your hand all the way through the mortgage application process until you actually move into the property. We get paid by the mortgage lender on completion, which essentially means that we get paid an introductory fee by the mortgage lender for introducing your business to them. As such, there's no fee charged yourself because the lender makes money from charging interest on a mortgage or a loan to you. And we make money by the fact that we introduce yourself as a client to the lender, and we basically ensure that your mortgage completes to make sure we get paid by the lender for the work that we do. So First Mortgage, as I said, we specialise in financial wellbeing sector. We've got relationships in both the private and the public sector. The public sector mainly being the NHS and the MOD. In the private sector, we work with a lot of big businesses, including the likes of Specsavers and Amazon. We provide the well-being and the financial well-being, the employee benefits mortgage service for 90,000 staff across Amazon in the whole of the UK. We've got a contract with Amazon there, as well as a host of NHS trusts. So we've got a free mortgage education service. We've got a free protection review as well. Alongside the mortgage, we'll also ensure you're financially resilient, and you can ensure to maintain your mortgage throughout the term you look at, whether you look at 25, 30 or a 35-year term. We want to make sure yourself and your family can afford that mortgage not only now, but also in the future. So we'll review your protection options to make sure you've got things like life insurance, illness cover, any income protection alongside the mortgage to make sure that you are financially resilient against the worst happening throughout the mortgage term. In terms of our operation, so we're open for business 6 days a week, Monday through to Saturday. We do generally consultations online, so on Zoom or sort of Teams calls. We can do phone calls as well. And we're available 9 a.m. through to 7 p.m. in the evenings, and available on Saturdays as well. So feel free to email the team and book in, and we can get you booked in with one of our team to speak to one of our mortgage experts, all for free. Okay, so in terms of how we operate, so as I mentioned earlier, we're a whole of market broker. Essentially, that means we're not limited to a small panel of mortgage lenders. So a lot of mortgage brokers you see will charge a fee, which we don't charge a fee at all for any NHS staff. Those fees range between £300 up to £1,000 just for an advice fee. We don't charge a fee at all for the advice we provide. Now, because they charge a fee, they class themselves as independent. And as an independent broker, that means they get access to a much smaller panel of lenders, anywhere between 7 and 8 lenders they can choose from. Because we're a whole of market broker, we've got access to over 90 separate lenders and over 12,000 rates available on a daily basis. Our team are very experienced. We're highly versed with NHS staff. We've done thousands of mortgages for NHS staff over the years. Between us, in terms of the advisor we've got working in office here, we've got the best overall advisor in the UK, the best new build advisor, and the best first-time buyer advisor across the whole of the UK, winning awards at the British National Awards, British Mortgage Awards, in terms of our experience. So yeah, we've got all our advisors here, all over sort of 10 years experience in terms of the NHS advice we give. So in terms of the topic today, let's move on. And so any questions, feel free to put them in the chat. I can answer any questions at the end, or we can wait until the end of the webinar and ask questions then. So one of the most important things to do before you get mortgage ready is make sure your credit score is okay. You don't want to basically go through the whole process, get an offer accepted on the property, get all excited about buying a property, apply for the mortgage, and the mortgage gets declined because you've got poor credit. So best thing to do is sign up to one of the big 3 credit agencies, the likes of Experian, Equifax, or TransUnion, which covers sort of the major 2, and obtain a copy of your credit report. Have a look at that and make sure that your credit file, you've got no blips on the credit file, you've got no county court judgments against you, you've got any defaults or any bankruptcies or any IVAs or debt management plans. If you have, don't panic. There are ways and means around it. We can advise on what we call credit impaired applicants, where you're looking to buy and you've got issues with your credit report. It just needs some specialist advice, but you need to make sure you've got nothing on your credit report you're not aware of. So most mortgage lenders use your credit score basically to determine your eligibility and worthiness to borrow money, which is why it's so important to make sure that you know where you are with your credit report. Now, the likes of Experian have got a free trial, I think a 7-day free trial now, where you can sign up to Experian, put your bank details in, and you get access to your credit report for 7 days. As long as you then cancel that subscription within 7 days, you won't get charged. So it's worthwhile signing that up and downloading a copy of your credit score. If you want to discuss that with one of our advisors and see if you're going to be eligible for a mortgage, feel free to book in with one of the team on our contact details below on the screen, and we can obtain your credit report and have a look for you and discuss that with you. Now, ways to improve your credit score. The major one is going to be get on the voters roll, get on the electoral roll. And the way to do that, to register to vote, is speak to your local authority, get on the council website, and basically register to vote on the council website. Other ways to increase your credit score: ensure all payments are up to date. So try not to have any missed payments between now and the time you look to apply for a mortgage and beyond. Avoid any payday loans if you can do. They're a big no-no from a mortgage perspective when you come to apply for a mortgage. Also try to avoid for a couple of months at least any Klarna payments or any similar payments where you pay for things monthly on interest-free installments. Some mortgage lenders look negatively at Klarna payments as it's a short-term form of borrowing. Don't miss any credit card or loan payments, and try not to get up to the maximum on your credit card balance limit. So if you've got a limit of say £5,000 in your credit card, try to stay within 80% of that limit. So £4,000 in that example. Try to stay within the 80% limit, otherwise it will affect your credit score and it will basically reduce your credit score down a little bit if you're up and close to your credit limit, as it shows to credit providers that you're utilising the maximum you can borrow and you're not paying that off in time. In terms of documents required when you look to buy a property or when you come to either get a purchase mortgage or even a remortgage, which is refinancing the property in the future. So what do lenders look for? So basically lenders need to see proof of ID and proof of address for you. They essentially need to identify from a fraud perspective, you are the person you say you are when you come to apply and you live at the address you say you live at, so they can basically trace you in terms of credit scoring over the last 6 years when you come to apply for a mortgage. So in terms of proof of ID, very simply, it's going to be a valid passport or a full UK driving licence as proof of ID for you. In terms of proof of address, usually it'll be a utility bill with your name on, dated within the last 3 months. So that can be a gas, electricity, or water bill. The lenders don't accept any mobile phone bills at all. If you don't have a utility bill, you could use potentially an HMRC tax coding notice with your name on. You could use a annual statement in terms of council tax statement. Or if you've got a UK driving licence, you can use your UK driving licence, which shows your address on as proof of address, alongside your passport as proof of ID as well. So you need to get proof of ID and one proof of ID, one proof of address already before you come to apply for a mortgage. As likelihood is you'll probably need that when you come to apply for the mortgage, not only with the mortgage lender, but with the solicitors who are acting on your behalf to basically get the transaction through with the Land Registry as well. You can also use a latest bank statement if you've got a hard copy bank statement or a hard copy credit card statement delivered through to your home address. You can use that as proof of address. Question I always get asked on these webinars, if you've got online bills, all you need to do is jump on your online profile and just change that to paper statements just for a few months before you come to apply for a mortgage. You'll then get paper copies through the post, which you can use as proof of address for you, which on the bank statement or credit card statement shows your name on, shows your address, and that acts as proof of address when you come to apply for the mortgage. In terms of income documents, so part of obviously any mortgage application, a mortgage lender needs to ensure that you borrow enough money to be able to afford the mortgage that you need to obviously get the property. And by that, most people, NHS, generally speaking, 90% of people we speak to are employed PAYE. So very simply, if you're paid monthly, we need the latest 3 months pay slips as proof of income for you. If you're paid weekly, we'll need the latest 3 months, which equates to 13 weeks of pay slips for you if you're paid weekly. If you're in between jobs, you're about to start a new job with obviously a different trust or within the trust, but a different job role, we just need a confirmation letter from HR, which basically got your name on, but all your details. It's on letterheaded paper and it confirms when your new pay rise or promotion or whichever job role you start is to come into effect. As long as that job role starts within 3 months at the time you apply, we've got lenders that we can apply 100% of that new income or new job role to borrow a mortgage. So for example, you've got a new job which is starting on the 1st of March within 3 months, and you've got a letter to confirm that your salary is going to be £5,000 more than it is now, we can use that higher income before you've even started that job role, as long as you've got a letter to confirm it. For those of you that are self-employed, just need the latest 2 years tax calculations from HMRC as proof of what your net profit has been for the last 2 years towards proof of income when you look to buy a property. But the main things really, most of the NHS staff we speak to are PAYE employed. We just need your latest 3 months pay slips as proof of your current income for you. In terms of additional supporting documents, so a lot of lenders will ask for proof of deposit. So if you've got, say, for example, one bank account with all the money in for your deposit, we'll just need probably 3 months bank statements. If you've got 10 separate bank accounts or 10 different ISAs or lifetime ISAs with different statements in, you'll need to gather all of those accounts and basically the latest 3 month statements for each of those accounts as proof of your deposit. So just make sure you're aware of that, so that you don't get stung with a lot of admin to do when you come to apply for a mortgage, because you'll need to basically provide evidence of where that cash is you've got for the deposit. If you are lucky enough to be gifted any money from family, then we'll basically send you, when you come to apply for a mortgage, what's called a gifted deposit template letter. And that gifted deposit template letter essentially is signed by the donor, the person gifting the money to you, and that will basically suffice as proof that they're giving the money to you. Lenders sometimes need 3 months bank statements from the person gifting the money to you, so just make sure they're aware that they may have to provide 3 months bank statements as well. If you're selling a property and buying a new one, and you're using the equity from the sale to buy the new property without any of your own cash to put in, you'll simply need a memorandum of sale from the estate agent who is selling your current property. In terms of generic questions to ask when you buy a new property, so these are, I guess, are particularly pertinent for properties which aren't new builds. So if there's any extensions or significant renovations have been done on the property, just ensure when you speak to the estate agents that they confirm with the vendors or the vendor solicitors that you've got adequate certificates in place. As part of the due diligence, lenders will need to basically confirm, or their legal team will need to confirm, that any alterations have got the necessary planning agreements in place, or the permissions, any certificates for any sort of significant works have been done. If they haven't, it does cause a few delays later on when you come to complete, and you might need to get some last minute indemnity policies with your solicitors, which can be costly to yourself before you come to apply. I say costly, they're not disastrous. It might be a few £100s, but it just makes it worthwhile when you come to buy a property. Just ensure that there are certificates in place for any works that have been done since the current owners bought the property. Otherwise, in terms of surveys, so when you come to buy a property, again, really depends on the age and the condition of the property. It's always worthwhile getting a survey on a property. If you're spending several £100,000 on a new property to buy, it's worthwhile paying money to ensure that the property you're going to buy isn't going to fall down and it's structurally sound to lend against. So there are 3 levels of survey available. For mortgage purposes, you've got the very basic valuation. That's confirmed by the lender's own nominated surveyor, and they'll come out to the property, and it's very basic in nature. They'll probably be there about 20 minutes in all honesty. They'll confirm the property is structurally sound to lend against and it's worth the money you're buying it for. Not a lot else. And that is usually free of charge as part of the mortgage package when you come to apply for a mortgage. Some lenders charge around £100 for basic valuation. Home buyer survey is the next level up. So that's level 2 survey. It's a lot more detailed, and that's where the surveyor actually acts on your behalf as opposed to acting on behalf of the lender. But they will still send that report back to the lender as basic confirmation the property is suitable security to lend against and that it's worth the amount you're buying it for in the current market. So in terms of detail, the home buyer surveyor will probably be at the property for around 3 or 4 hours, and they'll be looking at anything from any dry rot to the woodwork in the beams of the loft, any damp issues at all anywhere in the property, effectively anything that could be quite costly to fix when you move in, and those details will be on the report for you. So before you make a decision to buy the property, you've got confirmation on that survey report that there might be any issues which might need resolving. A full structural survey is the most thorough and most expensive report available. It's a lot more in depth. The surveyor will be there probably for half a day or so, but maybe a bit longer. And again, they'll look at anything in the loft. They'll look at around the property for any sort of signs of heave, landslip, or subsidence at all. They'll check that all the utilities are working, so the gas, electricity, water supply are all functioning okay. There's no issues there at all. They'll also look at the roof as well. So the last thing you want to do is move into a property and find out within 6 months you've got a 20 grand bill to pay for a new roof. So I said it's worthwhile, especially for older style properties, having a more thorough survey done just for your own peace of mind to ensure you're not buying a property which is going to cause you thousands of pounds and a big headache later on down the line. If you're buying a flat especially, usually a flat is advertised as a share of freehold, but it's also a leasehold property. So they'll have an individual lease on each property. You need to ensure that there's how many years left on the lease of the property. If you're buying a flat with less than 80 years on the lease remaining at the time you apply for a mortgage on the property, it could be problematic in trying to get a mortgage on it. Lenders generally need you to have at least 80 years remaining on the lease term before you buy a property. Also check out what the ground rent costs and the service charge costs are on the property as well, as a lot of lenders factor into account any ground rent or monthly service charge costs into affordability, and they treat it as a deduction. So although online calculators might confirm how much you can borrow based on your income, that's why it's worthwhile speaking to mortgage experts such as ourselves, as well look at any hidden costs that lenders look at to ensure you get an accurate reflection of how much you can borrow based on all the costs involved with any particular property in mind. Other generic questions to ask about the property before making an offer. So this really is more about negotiation and trying to get the best price for you. So try and establish with the estate agent when you come to buy a property what the current owner situation is. i.e., is it a couple getting divorced? Is it a probate property where somebody's died in the property? Do they need a quick sale? Have they found a property they want to buy themselves? And just try and find out what the position of the buyer is. All of those factors will influence what price you might be able to get the property for. Because although it's advertised X amount, if the vendor needs a quick sale and you can confirm that you've been financially verified, if you've spoken to a mortgage broker such as First Mortgage, and you can confirm the mortgage you need to borrow is available with a decision in principle certificate I mentioned earlier, essentially it might be that they can accept a lower offer for you if you can move quickly. Also look at any nearby properties that are sold in the recent area. So you don't want to buy a property which is a terrace property, for example, next door sold for £50,000 less a month ago, and you're paying £50,000 more, and you're overpaying for the sort of the value of the property. So try and search for nearby properties in the same postcode with a similar square footage to ensure that you're getting value for money when you come to buy a property as well. As regards to the house buying process, so in terms of what that involves, so before you come to make an offer on a property, as I mentioned at the start, you will need to get financially qualified before making an offer. Typically, that takes around 30 minutes, sometimes a little bit less, sometimes a bit more, depending on how many applicants are on the mortgage. Anywhere between 1 and 4 applicants on a mortgage. Typically, it's 2 people or a single applicant if you're just buying in your own name. The mortgage broker will essentially ask a lot of information to confirm your situation. So they'll confirm your full name and address, as be a passport and proof of address. They'll confirm your income status, if you're in a permanent job role, when you started the job role, who you work for, what your income is per annum, any shift allowance or any overtime for the last 3 months. They'll ask for all that information. They'll require information as regards to any credit commitments you might have. So any unsecured borrowing in terms of personal loans, any hire purchase agreements, any credit card debts, and they want to make sure that whatever we apply, when we come to apply for the mortgage, that's all disclosed to any mortgage lender, and we take that into account for affordability. With all that information, alongside a bit more detail as regards how much deposit you might have available for a deposit on a new property, the mortgage broker will be able to work out quite quickly how much you can borrow as a maximum across all the lenders we look at. At that stage, they can provide you with a decision in principle certificate, and that certificate essentially says that Mr. and Mrs. Smith, for example, can borrow up to £300,000 based on their joint income over 25 years. Here's a certificate, and you can then use that decision in principle certificate to provide towards a estate agent or a new build developer as confirmation that you can borrow enough money to get a mortgage on the new home that you want to buy, and you've been financially qualified. At that point, the estate agent can take the property off the market. So once you get an offer accepted on the property, that is safely yours and it's not going to be sold to somebody else. The next steps in the process, so once you've negotiated on the price and you've agreed a price with the vendors of the property and the estate agents, and you've had the offer accepted, get back in touch with your mortgage broker at that point. The mortgage broker will then discuss a range of options with you in terms of whether you want a 2-year, a 3-year, a 5-year fixed rate. They'll look at the mortgage term, whether you want a 20, 25, 30, even a 35-year term based on your monthly budget, and they'll run through and put together a package which suits your circumstances as best as possible, and they'll provide a formal recommendation in writing for you. At that point, if you're happy, the mortgage broker, again all free of charge from First Mortgage, will apply for the mortgage for you, and they'll then secure the rate, and they'll deal with the whole process from the start to the finish in terms of liaising with the mortgage lender to get your mortgage offer issued. Once a mortgage offer is issued, that is then over to your solicitors to complete on the purchase between yourself and the vendors of the current property who own the current property at the moment. So what is the solicitor's role? The solicitor's role is to ensure that you're the legal owner and registered as a legal owner under the land registry of the new property you come to buy. So they'll liaise with the vendors' solicitors in terms of making sure all checks are done on the property in terms of searches for yourself. They'll report back on any issues with the property as well that come up in terms of any environmental issues, anything else which might show up with, for example, any planning applications for, say, a new shop or a supermarket within 100 yards of the property. Anything which might materially affect, obviously, the consideration for you buying the property and not being given by the vendors will come up on those reports. But their job is very important. So they're there to protect you, but also legally make sure that you're the legal owners of the property on completion, so that Land Registry have you down as the new registered owners and keepers of that house you look to buy. In terms of financial protection, so I mentioned at the start, it's very important to ensure that we make sure that you are covered financially, not only now, but in the future. So we want to get a mortgage for you, but we want to make sure that should the worst happen, you are covered in the future and you and your family can continue to maintain the mortgage payment and cover all your bills on a monthly basis. having sufficient mortgage and financial protection in place, okay, is a prerequisite with a lot of lenders out there to make sure that you have got enough cover in place to ensure that should the worst happen, you can still maintain the mortgage and they never have to repossess the property and sell the property to pay the mortgage back. So reasons why you really should review your cover at any point, either now or in the future. Whenever you come to buy a property or you remortgage, it's worthwhile reviewing your cover. If you're buying your first home or your next home, if you're having a child or having another child, if your occupation changes or your job role changes, or if your income changes, um, essentially any material changes to your lifestyle which will affect you, you need to review your financial cover to make sure that any cover you've got now or haven't got, you need some sort of cover in place to ensure that should the worst happen in the future, you can still maintain the mortgage. Unless you've got hundreds of £1,000s of savings, which not a lot of people do, otherwise you wouldn't have a mortgage. It's always worthwhile having some protection in place to cover you financially, because I think the average that most people have in savings is about 6 weeks worth of income should the worst happen. And if you're off work for a long period of time, how are you going to maintain the mortgage with no income coming in? So when it comes to financial protection, there are a number of options. I'll run through them very quickly. You've got basic life insurance, which essentially provides a standalone insurance so that should any applicant pass away, you can basically put your money in trust to go to any identified individual, whether that's a partner or a child or a family member. You can basically have them as the beneficiary. So if you pass away, the money goes to them and they can use that money to basically clear the mortgage for you, so they're not in a position to sell the property to pay the mortgage back. Very similarly, you've got a family income benefit policy, which on death, it pays out a tax-free lump sum, but that tax-free lump sum is paid out in equal monthly instalments, which allows a lot of people, widows especially, or anyone else who has been affected by a death in the family, to maintain any bills on a monthly basis so they can budget on a monthly basis to have the same financial lifestyle, should that person not be around. You've then also got income protection policies and critical illness cover. An income protection policy essentially covers your income should the worst happen if you're off work for a long period of time. It allows you to maintain an income for the foreseeable future. It's called permanent health insurance policy as well. It's a permanent policy, pays out until you're well to return back to work after being signed off work by a doctor, and it will pay you an equal monthly lump sums to basically cover the mortgage and all your bills. A critical illness policy, lastly, pays out a tax-free lump sum if you're diagnosed with a serious illness such as cancer, heart attack, or stroke, and that allows you to clear the mortgage debt should the worst happen to you. So in summary, yeah, financial protection is very important. That's why we covered so much time on it today. If you take it on a mortgage, you want to make sure it's affordable now and in the future, and you're never in a position whereby, should the worst happen, you've got to sell the property to pay the mortgage back. Okay, so that's covered the mortgage topic today and what questions to ask when buying a house and getting mortgage ready. I'll give you a very quick mortgage market overview of where we are with rates at the moment. There'll be a quick opportunity for a Q&A at the end of the webinar as well. So mortgage rates, where are we? So the Bank of England base rate was actually brought down on the 20th of December last year, just before Christmas, from 4% down to 3.75%. Reason being is that inflation has been brought a lot further back under control. So the government target is to hit inflation at 2%, but it has been going down a lot, especially since the highs we witnessed following the aftermath of the mini budget in 2022, when the Bank of England base rate reached a peak of 5.25%. Inflation was up to almost 11% at that point. Since then, inflation has come back a lot under control. As of December, that came down to 3.2%. And in which case the Bank of England base rate has dropped from 5.25 down to 3.75% as a result. Inflation numbers for December were released in the press yesterday. They came in a little bit higher than anticipated at 3.4%, which basically means it's going to be a dead cert now, really, that the Bank of England base rate is going to be held at the next Monetary Policy Committee meeting on the 5th of February, in just over 2 weeks from now. So we are expecting a hold of 3.75% of the base rate. I predict now up until April of this year, at which point I predict that the Bank of England base rate is going to drop down to 3.5% in April, assuming that we're on track for inflation numbers to drop. Inflation really is probably the biggest factor which affects the decision of the Bank of England base rate to reduce the Bank of England base rate down, and the Monetary Policy Committee to vote in favour of any reductions. There are then predictions in the industry for a further up to 2 more base rate reductions following a base rate cut in April. So by the end of 2026, we should be looking at a Bank of England base rate coming in anywhere between 3 to 3.25%. Only global factors, such as Donald Trump and his many philosophies, or any obviously global escalations of war, for example, the Ukraine war crisis, or any sort of new war breaking out, could affect the global economy and could obviously affect inflation over here in the UK, which therefore could impact on how quickly the Bank of England base rate is actually brought back under control. However, touch wood, all being well, we're on track to have anywhere between 2 and 3 base rate reductions by the end of 2026, and we should be seeing the base rate come in between 3 to 3.25% by the end of the year. So that translates into mortgage rates. As of today, we're looking at mortgage rates anywhere between 3.7 to 3.8% for the best 2-year fixed rate on the market if you've got a relatively high deposit of 25% or more. We're expecting mortgage rates to come in a little bit better by the end of this year, typically anywhere between 3 to 3.25% in line with the base rate by the end of 2026. So that is the end of the webinar. Thank you for jumping on, and thanks for your time in listening to me obviously discuss the topic today. I'll leave the webinar open. If anyone's got any questions, feel free to put any questions in the chat. I'm going to be here for until anyone's got any last questions. Otherwise, feel free to log off if you've got the information you need. So this has been saved. It has been recorded, and the Wellbeing team will be basically sending this round at a later time. But hopefully that's been helpful and given you a few snippets of information on the house buying process, especially those of you who are first-time buyers who've never been through the process. But yeah, I'll be quiet now, and any questions, feel free to put in the chat, and I can answer any questions for you. Thank you. Cool. Okay, question come in. Sam, I think it's just you and me on the chat now. So, good question. How do brokers get paid? So essentially, yes, we get paid by the mortgage lender on completion. So because we're a whole of market broker, we don't charge a fee. So lenders will basically pay us for introducing your business to them. So the reason being is that it takes away the cost of them having to advertise the rate, because brokers do that, and we basically got a sourcing system which basically itemizes the best rates on the market from the best rate down to the last. So if it's with Nationwide, for example, and you're eligible for a deal with Nationwide, we'll say, Sam, this is the best rate available in the market at 3.84% with a £999 fee. We recommend you take this product. We then do the full application for you and process the application, which takes away the cost of Nationwide having to pay their staff to do that. So Nationwide then receive a fully packaged application from First Mortgage with all your details on. They get it their end, essentially it's a tick box exercise, and they then agree that they stamp the loan, and then the mortgage starts on the day you complete on the property. So at that point, they're then obviously you're then paying interest to Nationwide directly, as an example, and they're making thousands of pounds of interest on you, and they'll then pay us an introductory fee for introducing business to us. So a lot of brokers do charge a fee on top of that. So every single broker will get charged a fee. Every single broker will get paid by the mortgage lender. Once your mortgage completes, a lot of brokers elect to charge a fee. We just happen to be a fees-free broker, and that's been our philosophy since day one. We've been going for over sort of 25 years. We've got a massive backbook of clients, so we don't elect to charge a fee, and we don't charge a fee to any NHS staff. So that's a long way of me saying no, there's no charge at all.
Excellent, thanks, Ben. What I wasn't sure is if you get paid by the lender, if that then affects the rate that they give to the borrower, but it doesn't sound like it does.
No, not at all. No, so we get paid a set fee by the lender. It doesn't impact on the rate at all for you. So the rate's basically dictated by the market and swap rates, which is the rates that lenders lend to each other in the interbank market behind the scenes, or the SONIA overnight rates, they call them. But yeah, if whatever we get paid by them doesn't impact on the rate at all.
Brilliant. My wife and I are very nearly at a point, I think, where literally over the next week or two, we're going to need to get the ball rolling. I think we're quite keen to get the house we live in at the moment on the market.
Brilliant. Okay.
But neither of us have gone through this process before. We're homeowners without a mortgage, because the home we're in at the moment was bought by my wife's parents